Hello everyone. Today we're looking at straight line depreciation. I am working through the example in your resource book on page number 16. So straight line depreciation means that the depreciation per month per annum stays exactly the same. So when we purchase the asset, we purchase the asset on the 1st of the 7th, 2018. We have the historical cost or the asset cost being 35,000. The residual value, in other words, the amount of the asset that we have left over at the end of the day, is worth $5,000. So I want to work out how I get my depreciation expense per month or per annum. What I'm going to do, I'm going to delete my schedule that I have created, and I'm going to work out how I went to creating that schedule. First of all, with straight line depreciation, we've got to calculate the depreciable amount. Now, the depreciable amount with this type of depreciation is always the asset cost less the residual value. So if I say asset cost less my residual value, I'm going to get the total of $30,000. We told in the example that the estimated useful life is 3 years. The depreciation per annum therefore is the historical cost minus the residual value divided by the useful life. Please remember that we always deduct the residual value when using straight line depreciation. So we've taken the historical cost, we've subtracted the residual value, and we have got the depreciable amount. We now need to say the depreciable amount divided by the number of years that we have that asset for. That means our depreciation per annum is going to be $10,000. If you want to work out the rate of depreciation, a very simple formula needs to be used, and that's depreciation per annum divided by cost. So if we say depreciation per annum of 10,000 divided by the cost of the asset of 35,000, we're going to get the depreciable amount of 28.57%. So then we go to create our depreciation schedule. We're going to start off with the asset cost, okay, and we use the historical cost. We don't use the depreciable amount. That's why I've color coded them both the same color. Our depreciation expense for the year is going to be $10,000. Okay. Now, because it's straight line depreciation, that $10,000 is going to be the same every single year. Okay. So we're going to take the $10,000 and we are going to copy it down into each one of those cells. Accumulated depreciation is how much depreciation has accumulated so far. And we've only had one lot of depreciation expense, so our accumulated depreciation is the same as our depreciation expense. The carrying amount at the end of the year is going to be the historical cost less the depreciation for that year. So our carrying amount at the end of the year is 25,000. We then carry that amount over to the start of the next year. So this column can also be headed opening written down value. So our depreciation the next year is $10,000. So our accumulated depreciation is now $20,000 because we've had $10,000 the first year and $10,000 the second year. Our carrying amount at the end of the year is our opening written down value less the depreciation expense gives us $15,000. That's why the carrying amount at the end of the year can also be called closing written down value. So remember, in accounting, there's lots of terms for the same thing, and it's important that you understand that. We start the next year and we open it with the closing amount from the previous year. We have our depreciation expense for the year. Our accumulated depreciation is all the depreciation that we've recorded so far, and that gives our closing written down value of our opening less our depreciation expense gives our closing written down value. Now you'll see I've color coded it green, which is showing that our closing written down value on our depreciation schedule is the same as our residual value. That's why when we created the schedule, we started off and we entered in the historical cost of the asset. So it's important for you to remember that every time you have an asset in a business, you create a depreciation schedule for that asset. Now, when we go to classify what is a depreciation, what is accumulated depreciation, depreciation expense is exactly that. It is an expense. So we know that when we put the amount into the general journal, an expense increases on the debit side. But accumulated depreciation is a negative asset or an asset going down, and an asset goes down on the credit side. But let's see, why is it an asset going down? Well, on our balance sheet, and please remember that this is just an extract of the balance sheet, we start off with the historical cost of the asset, which is 35,000. We then say, well, what is this asset worth to us at the end of the first year? So we say less the accumulated depreciation in the first year, which is $10,000, which means that the closing written down value of that asset in the first year is $25,000. That's why accumulated depreciation is known as a negative asset or an asset going down, because it is reducing the value of the asset. What about the third year? If we were to do this extract on the balance sheet in the third year, what would it look like? Well, our accumulated depreciation would be $30,000, meaning that our closing written down value of that asset is $5,000.